Hi everyone, Billy here from iTradingU, and today we will cover the second part of our beginner's guide to understanding how options work. If you recall from my post earlier this week, there generally are two questions that I get asked very frequently by new investors or novice traders whenever they start investing or using options. My blog post from earlier this week spoke about the first question, in other words, which strike do we choose? And I do invite you to have a look at that post whenever you have some time. I'll be sure to include a link to that blog post in the comment field below. Today's post, though, will cover why do we use options instead of just buying the shares outright. So let's have a look at that. In this particular instance, it's going to be easier to explain options if we take an investment motive and using options to replace the shares in an investment strategy. So let's start by looking at the motive for your investment. I would bet that if you are investing in shares, you're probably looking for some sort of long-term capital growth as part of a holistic portfolio that you're investing in. So let's look at an investment in 3M for an example. The current share price is $143. So if you were to buy 100 shares in 3M, you would have to spend $14,300 today. So in other words, that's the investment capital that you're going to require to buy 100 shares worth of 3M. Now let's look at this. If you bought the shares at $143 and the share price goes up to $200, can you see that you have all the benefits in that movement? In other words, your 100 shares, now valued at $200 a share, is now worth $20,000. But similarly, the downside risk exists. What if the share price falls to $80? Your 100 shares, once again, will now be worth $8,000. From this description, it becomes clear that owning the underlying shares, you have full exposure to both the upside as well as the downside risk involved with investing in shares. Now let's look at what happens when you use options as a replacement strategy for just buying the shares outright. So the two concepts we're going to address today is how does the actual options price change as the underlying share price moves? And the second part is, how much premium exactly are you paying for the time aspect of options? So let's look at them one by one. Let's look at share price movements in relation to how an options price reacts to that. And in order to do so, I'm going to assume that you own an option that you took out a while ago. So originally the period was for 100 days, and we are now at the final 2 days of your options. So we have day 99 going and day 100 right after that. The option that you own was done at a strike rate of $10. So just to recap, a strike rate is the effective rate at which you're going to transact when you exercise your option. So in this case, when you exercise the option, you're going to spend $10 per share. On day 99, the current share price is trading at $150. Would you agree that if you own the option, this will be a call option, if you own a call option at $10 a share, that the call option value should be very close to $140? How did I get that? I'm saying the current share price is $150. If I can buy them at $10, that is worth a hell of a lot of money. And in fact, it's worth the difference between my share price and my strike price, which is $140. Now let's assume the share price moves 1 day forward. And in doing so, it moves up to $200. Let's now think logically about it. By how much do you think the option price would have adjusted if this is the final day of us having this option? So in other words, today we're going to exercise this option and buy the shares. So how much do you think it's worth? In essence, it'll be worth $190. And how did we get that? The share price is now worth $200. We own the right to buy the share at $10. So by spending $10, we're going to be able to buy something that's worth $200. So that is worth in and of itself $190. Because remember, this is the final day. Today we're exercising the option. We don't have anything else to worry about. So let's look at this. The share moved from $150 to $200. That's a $50 move in the share price itself. How much did the option price move? Well, it went from $140 to $190, which coincidentally is also $50. Now that should make sense at this point, because think about it. We only moved 1 day forward, and this was right at the end of our option expiration. So the option value increased by 100% of the value of the underlying shares. Let's look at this a little bit differently. How would that have worked if we were in the beginning part of the option trade? So in this case, we're once again talking about a 100-day option that we've bought, but we're now only sitting in day 10. So we've got 90 more days to go from here. So with the current share price at $150, let's for example assume it's also worth $140. Just a caveat, it won't be worth $140, but again, just for the sake of simplicity, I want to explain a concept here, nothing else. So let's assume the current share price is $150 and the current option price is worth $140. Now once again, we go from day 10 to day 11. Share price goes up from $150 to $200. So that share movement there was again $50. But now let's think about it. Do you think the option price would reflect the full $50 that the share price moved? The theory behind this would be it won't, because remember, we are now only on day 11 and we have 89 more days for this option to move. And what if the share price drops below 150? So you can see that the option price at this point will only reflect a small movement. In this case, the option went up by $30, which is 60% of the movement of the underlying. Now that still is a lot of value in terms of movement, and that is something we'll bank on when we start looking at the strategies itself. So the idea here is that options take into account the effect of time. So in other words, what is the likelihood of this event occurring, and how much time do we have left before the option needs to be exercised or not? Knowing how option price reacts to time as well as the underlying share price movement, we now can understand how to pick the correct strike relative to the strategy that we're looking to achieve. So given that our motive is going to be investing in shares, we will look for an option strike rate where the price movement of the actual option closely reflects the price movement of the underlying shares. And how would we do that? Quite simply, we will look for an option that is called deep in the money. Let me show you what I mean. Here I have a screenshot of an option pricing chain for 3M. You will remember we would need a strike that is fairly certain of being exercised in order for our price movement to react in line with the underlying shares. Now this concept is called in the money. So in other words, we are going to buy an option where the option strike rate itself is far better than where the current market share price is. So look at this. For January 16 next year, in other words 2015, if we look at a strike rate of $130, it shows a delta of 79%. That's almost 80%. This in effect means that should we buy this call option and the underlying share price of 3M goes up by $1, the price of our option that we've just bought will increase by 80 cents. In other words, 80% of the movement. So that's really what we want here. We can even go a bit further and look a further year out. So in other words, January 15, 2016, an option here at 130, this again is going to be a call option, reflects a price movement of 70% of the underlying share price movement. So given the additional time, an additional 1 year, you could even consider buying that option. But let's just stick to the January example for next year, in other words 2015. Now remember, our goal here is to look at comparing the option with holding a long-term investment. Yes, when trading options we can definitely do stuff more difficult and more technical, but for now I'm only explaining a concept, so bear with the example for a second. There is one more thing that I want to show you before we look at actual sums. Let's look at the January 16 call option again. This one struck at 130 will cost you $15.15 to buy. So if we take the price at which we are now able to buy the option and we add this to the 130 strike rate. So in other words, if we exercise our option, we're going to be buying the 3M shares at $130, but we're spending $15.15 to buy the option. So the total price, all said and done, when we end up buying 3M shares, will be $145.15. Now the market currently is trading at $143. So in essence, we are paying $2.15 to expose ourselves to the share price movements, and this is going to be until January next year. This is a very, very nice place to be, considering that you really don't have anything to worry about. Because think about it. If the prices goes up from here, you have full exposure to the price movement. But if the prices go down from here, you'll be able to sleep soundly knowing that you will never ever lose more than $15.15 per share. Never ever. So that is a very, very powerful position. And I call it almost renting shares. So the cost of renting shares is really the difference of $2.15. And to me, that sounds fairly cheap considering the light that you have exposure for almost, let's call it 6 months from here. So if you wanted to and you want to actually do it further, you can spend an additional $3 or so and control these shares until January 2016. That's awesome. But now let's look at some real numbers. How much will it cost to buy 100 shares outright of 3M? Well, with the current share price at $143, 100 shares will cost you $14,300. This again will be the physical capital that you have to put down to buy the shares. we can consider this to be your investment amount. Now let's compare that to buying the option on 3M. So in other words, we just control the shares of 3M, but also 100 shares of them. The current option price being $15.15, 100 shares of that will make the investment $1,000,515. That's an amazing difference, because think about it. You now have $12,000 that you can invest anywhere else in the market, or if you want, just leave it in the bank. Again, it shows you the power of the strategy in the sense that far less amount is needed to control the same amount of shares. And this here is the entrance level for beginners in particular, because think about it. How many of us can afford $14,000 just to buy one company share? In our example, if we had $14,000 and we use options, we can then spend $1,500 on the option and still have $12,000 left to go buy other shares in other companies. And in doing so, you'll achieve the effects of diversification. But more on that in a different session. I want to show you the actual outcomes in terms of owning the shares versus owning the options on the shares. So let's now fast forward to next year, January. And come January, the share price movement can be anywhere, right? Nobody knows where it's going to go. So what I've done here is I've depicted share prices on the left-hand side column all the way up to $200 and all the way down to $90. You'll see here that owning 100 shares of 3M, when we buy it today at $143, our profit will be, when the share price hits $200, our profit will be $5,700. I want to direct your attention to the bottom end. What happens when the share price drops to $90? You can see in this example, owning 100 shares outright exposes you to all the upside, but also all the downside of the shares. So when you look at $90 share price at maturity, your investment will now be worth $5,300 less. So that'll be the loss that you would take out if you would just continue to do or to follow a buy and hold strategy, which is what we're comparing the trade to. Let's look at owning 100 shares via a call option on 3M. You can see now here you just have to look at the yellow column on the right hand side. When the share price goes up to $200, the net profit on the strategy, and this is after taking into account the premium that we've spent, will be $5,400. So you can see the difference here is marginal. In owning the outright shares, you would make $5,700, and owning the call on the shares, you make $5,400. That to me is so close that I can consider these strategies exactly the same on the way up. Now let's look on the way down. When the market went to 90, do you recall your share position would be worth $5,300 less than what you started out with? But look how nice options works here. Remember, when buying options, the worst position you'll ever be in is just to lose your premium. So you can see, even though the spot goes to 90, you will have no exposure to that movement because you just don't exercise your options. And in this instance, the most you would have lost is $1,515, which equates to the premium you've paid for the option. So anywhere below 127.85, an option strategy outweighs owning just the shares. And if you put the two of them combined, you can see, first, you need less cash to do the option trade versus the underlying trade. Second, you have a non-symmetrical payoff, and this is in your favor. So in other words, you own all the upside. Even if you take out the small consideration of the premium, this is an unlimited upside. So if the share price goes to $1,000, you have all the benefit of doing that. Yet you've also limited your risk up front to spending only the premium, knowing that your loss will never ever be worse than that amount of premium paid. So hopefully by now you've seen the benefits of how important including options can be in a portfolio, especially if you're a new investor or a smaller investor where you have to leverage every single cent in your account for maximum returns. I hope you enjoyed this strategy and hope to speak to you soon. This is Billy from iTradingU. Bye-bye.